Numbers don't panic, people do. Let's look at the psychology driving today's market. An asset falls sharply. The first thing most investors want to know is where it was before. That previous price becomes an invisible anchor. But why should the old price matter? If the fundamentals have changed, the old price is no longer a valid reference, and yet it feels like one. That feeling is not random. It is a well-documented cognitive bias. The question is not why individual investors remember the old price. The question is what happens when an entire market anchors on irrelevant historical reference points and treats them as signals of true value. There is a cognitive bias called anchoring. It describes the tendency to make estimates by starting from a known number and adjusting from there. The problem is that the adjustment is almost always insufficient. In markets, the known number is often a previous price. A stock that traded at 100 feels expensive at 120, even if the fundamentals justify 150. The old price sets the frame. So we ask a specific question. When investors anchor on historical prices rather than current fundamentals, how does that anchoring contribute to sustained mispricing and delayed market correction? The observable pattern is recognizable. An asset drops from its peak, and investors call it cheap. Not because the fundamentals support the current price, but because the current price is lower than where it used to be. From a psychological perspective, the previous high serves as a reference point. Any price below that reference feels like a discount. The discount perception persists even when the previous price was itself the anomaly. When many investors share the same anchor, the resulting behavior becomes coordinated. Buyers enter at levels they perceive as discounts. Sellers resist at levels below their anchor. The shared reference distorts the collective pricing. This is where psychology intersects with market structure. Anchored valuations interact with order flow, margin levels, and institutional positioning to produce persistent mispricing that resists the information pushing against it. The anchor does not just affect individual decisions, it shapes the narrative. A stock that has fallen from its anchor generates stories about recovery. Those stories reinforce the anchor and attract more participants who share the same reference. And the anchor works in both directions. Investors can anchor on a low price and assume further decline, just as they can anchor on a high price and assume recovery. The bias shapes expectations in whichever direction the reference pulls. Tversky and Kahneman described anchoring as a bias where people make estimates by starting from an initial value and adjusting insufficiently, producing judgments systematically biased toward the anchor, even when the anchor is arbitrary. This means the starting point matters more than it should. The anchor does not need to be relevant. It does not need to be accurate. It only needs to exist, and the mind will adjust from it rather than computing from scratch. Notice the distinction. The investor is not lazy. They are performing analysis. But the analysis starts from the wrong place, and the correction from that wrong place is consistently too small. Furnham and Boo found that anchoring is one of the most robust cognitive heuristics, demonstrated across many domains and tasks. It affects both novice and expert decision-makers, though experience can moderately reduce its influence. In markets, this has a specific implication. Even professional analysts are not immune to anchoring. Their forecasts can be pulled toward reference points that have no structural relationship to the current fundamental value. The anchor's power is proportional to its salience. A dramatic high or a traumatic low creates a vivid reference. The more memorable the anchor, the stronger its gravitational pull on subsequent estimates. Structural factors can reinforce the anchor. When margin calls cluster near psychological reference points, or when stop-loss levels concentrate around historical prices, the market infrastructure embeds the bias into the trading system. So anchoring is not operating in isolation. It is a psychological tendency that interacts with market structure, institutional incentives, and information flow to produce systematic deviations from fundamental value. Here is the feedback loop. An asset establishes a price level through trading. That level becomes the anchor. Subsequent valuations start from the anchor and adjust, but the adjustment is insufficient. The insufficient adjustment means buyers pay too much when the anchor is high and sellers accept too little when the anchor is low. The anchor distorts the transaction in the direction of the reference point. Sen, Hillary, and Wei found that analysts make systematically optimistic forecasts when a company's earnings per share is lower than the industry median, and pessimistic forecasts when higher, consistent with anchoring bias. This finding suggests that even trained professionals anchor on relative benchmarks rather than computing value independently. The anchoring is not limited to individual investors. It can shape institutional analysis. When multiple analysts anchor on the same reference, their consensus becomes self-reinforcing. The anchored consensus attracts capital. The capital flow validates the anchored price level. The anchor becomes embedded. The narrative dimension amplifies this. As investors cluster around the anchored reference, stories emerge to justify why the price should return to that level. These narratives make the anchor feel fundamental when it is actually psychological. The crowd creates the feedback. Each investor who anchors on the same reference adds to the perceived validity of that reference. The collective anchoring produces what appears to be consensus but is actually shared miscalibration. The duration of this mispricing depends on how long the anchor retains its salience. Fresh anchors from recent dramatic events tend to be the most powerful. As time passes and new information accumulates, the anchor can gradually lose its grip. But the loss of grip is not smooth. Anchored investors resist updating until the accumulation of contradicting evidence overwhelms the reference. The correction often arrives as a sharp repricing when the anchor finally breaks. The asymmetry matters. Anchoring on a high price during a decline creates extended holding and delayed capitulation. Anchoring on a low price during a recovery creates premature selling and missed opportunity. Look, the disposition to anchor on purchase price specifically is well documented. Investors treat their entry price as a reference for whether the position is successful, even when the entry price has no structural relevance. During periods of sustained mispricing, the anchor can shift. A new trading range establishes a new reference. Investors who anchored on the old high now anchor on the new trading level. The bias does not disappear, it relocates. The interaction with leverage is important. Levered positions amplify the consequences of anchored mispricing. When the anchor breaks and the correction arrives, the leverage participants face magnified losses from positions justified by the wrong reference. When the anchor finally loses its salience, the repricing can be abrupt. Positions that were sustained by the shared reference collapse as the reference no longer holds. The correction compresses into a shorter period than the mispricing that preceded it. So the mechanism is: a price level becomes an anchor. The anchor shapes expectations. Insufficient adjustment from the anchor produces mispricing, and the mispricing persists until the anchor's salience decays or breaks. But not every reference to a historical price is anchoring bias. Some past prices carry genuine structural information. Support and resistance levels can reflect real order flow concentrations, not just psychological fixation. Anchoring theory alone does not predict how long the mispricing will last or when the reference will break. The duration depends on structural factors, information flow, and market conditions that the psychological model does not capture. Consider that using a historical price as a starting point can sometimes be rational. When information is limited and updating is costly, the last known price may be the best available estimate until better data arrives. The distinction is between anchoring as a starting point for analysis and anchoring as a substitute for analysis. When the reference is updated as new information arrives, it is an estimate. When the reference resists update, it is a bias. There are patterns consistent with anchoring-driven mispricing. When investor sentiment clusters around a historical reference that no longer reflects fundamentals, and the eventual correction overshoots, the sequence fits what anchoring theory predicts. But recognizing this pattern after the fact does not provide a reliable method for identifying the anchor's breaking point in advance. The bias is easier to diagnose than to exploit, so the thesis holds within boundaries. Anchoring can contribute to sustained mispricing by distorting valuation references, but it is one psychological factor among structural, institutional, and informational forces. Which brings us back to the opening question: why does the old price matter so much? From a behavioral perspective, the old price sets the frame from which all subsequent adjustments are made, and those adjustments are consistently too small. Investors are not pricing from fundamentals. They are pricing from the anchor. The anchor pulls the estimate toward itself, and the pull is strongest when the anchor is recent, vivid, or personally significant. But this is not a complete explanation. Anchoring may initiate the distortion, but market structure, liquidity, leverage, and institutional positioning determine how long the mispricing persists and how sharply it corrects. The value of understanding anchoring is not in predicting the correction. It is in recognizing that your own valuation may be contaminated by a reference point that has no structural justification. Price is evidence of transactions, not a direct reading of emotion. A price that appears cheap relative to its anchor may be fairly valued or still expensive relative to current fundamentals. The anchor does not tell you which. What anchoring theory offers is a framework for understanding one source of systematic mispricing. It does not tell you when the mispricing will resolve or which direction the resolution will take. Awareness of your own anchoring does not automatically correct it. The bias operates below conscious analysis. You can know the anchor is irrelevant and still feel its pull when making your estimate. The collective dimension extends this. Even if you adjust beyond your anchor, the market price reflects the aggregated anchors of all participants. Your correction is one adjustment within a field of shared miscalibration. Anchoring is one lens through which to understand why valuations resist updating. It does not predict direction or timing, but it reveals how past prices can distort present decisions across an entire market. Start by identifying your reference points. When you evaluate an asset, ask what number you are starting from and whether that number has structural relevance or merely historical familiarity. Separate the anchor from the analysis. If your valuation changes significantly when you remove the historical reference, the reference may be doing more of the pricing than the fundamentals. Observe the behavior, not the prediction. When you see an entire market clustered around a historical level without fundamental support, consider whether collective anchoring may be sustaining the mispricing. Remember that recognizing the anchor does not protect you from its effects. The bias operates at the estimation level, before conscious correction. Structured analytical frameworks can help reduce its influence. This framework does not predict when the anchor will break or how far the correction will extend. It explains one mechanism by which valuations can remain disconnected from fundamentals. Behavioral interpretation does not reliably predict price direction. Anchoring theory offers a way to study how reference points shape market behavior, not to position yourself for the correction. Anchoring reveals how historical prices can shape present valuations beyond their informational value. That is its contribution, understanding the reference distortion, not forecasting the resolution. Study the herd without following it. This is educational analysis, not financial advice, and behavioral interpretation does not reliably forecast market direction, magnitude, or timing. When the old price feels like the real price, the anchor is doing the work. Understanding that mechanism is the observation, not the prediction. Don't follow the herd, study it. See you next time.